All right, man, I think we're live. Howdy, Arla. I'm Justin. This is Jake Ryan. You guys know him from First Home Mortgage. So I've heard a lot of mortgage questions related to mortgage and in this pandemic we're dealing with. Saw a lot of questions in the Market Pulse survey that you guys all filled out on Monday morning. So thank you for that. But wanted to bring Jake on here as one of our local experts and really ask him some of those questions so you guys know exactly what's going on and continue to be the most connected brokerage in the DMV. So Jake, first off, I always like to ask, what's going on with interest rates?
Great question. Thanks for having me on today. That is a complicated answer. The quick takeaway is rates are better today than they've been in several weeks. There's a big disconnect when it comes to the mortgage-backed securities market and the rates consumers are getting. So things that are traditionally good for rates are not producing the same results. For example, the 10-year treasury, there's a huge spread now between mortgage rates that a consumer would get and what's going on with the 10-year. I made the analogy to you earlier. Imagine if in real estate, they put a Whole Foods next to a property, right? You think, oh, that's great. Value's definitely going to go up. On the other side, they put a prison, right? So it's conflicting data and conflicting signals. So what some may say is, oh, rates got to be going down or rates have to be going up. It isn't necessarily the case. The volatility with rates, so like the intraday changes, day-to-day changes, is at an all-time high. It's unprecedented. So things may be bad one day, but the next day, way better. So that's the long and short of it with rates. Overall, a lot better now than we were a week or two ago.
Okay, so for our clients that are saying, hey, rates are going to keep going down or rates aren't going down, should I lock now? What would you say?
So my recommendation to people is if you're comfortable with the payment, I would lock in. You could always gamble, but usually the pain of rates going up is a lot worse than the potential benefit of them ticking back down. Again, when we're in a time where just because the mortgage-backed securities market is improving or just because the 10-year is falling doesn't mean your rate's going to go down. We have capacity issues and investors are pricing all over the map. So again, if you're okay with the payment, I would lock in for as long as you can. I think big picture in the next few weeks, months, maybe throughout the year, I think rates are going to continue to fall. I think a lot of people are going to have an opportunity to refi. We've had a situation the last couple of weeks where too many people entered all at the same time and the system basically overloaded. So we had to raise pricing, investors pulled out, appraisal turn times changed, all of this. So eventually there is going to be a great refi opportunity. So my comment to people is get in, pay as little as you can right now in points, and then in 3 months, 6 months, a year from now, rates are lower, let's refi and take it down.
Can we extend our locks further? Is there any changes in what's going on with that right now?
So it depends. Some investors will only lock for 30, 45, or 60 days. You can extend. There's usually a cost to that. There's a lot of unknowns. So the typical stance right now is borrowers will be responsible for lock extensions. However, some of that will be a wait and see approach. Who knows if rates are going to be better or they're going to be worse. So it's going to be unfortunately a case by case basis, but in general, we're trying to be as flexible as possible, but there's a lot of unknowns. So that's why we're trying to lock as long as we can up front.
Okay. So if my closing, here's a question. If my closing scheduled in 2 weeks, can't my buyers just sign early like the sellers could?
Great question. Unfortunately, that's not the case. The way it's set up right now, the deed of trust, right, and the note, they need to be notarized and signed on the same day of settlement. So you can't, a seller with the regular deed, it can be signed days, weeks in advance, just like a contract can be signed at different days. But then there's a date of ratification. For us to deliver that to the investor, the note, right, the mortgage has to be signed and notarized the day of settlement. So they can't sign in advance.
Okay. Let's get away from originating loans and talk about my client who can't make their mortgage payment anymore because they got laid off. Do they have options? Do you know anything about those?
Unfortunately, that's going to be a very common question all too soon. You need to contact the servicer, right, who they pay, the loss mitigation department. I can share ours. We have a servicing company called Mule. All the big banks, Bank of America, Wells, Truist, which is now SunTrust and BB&T, they have options out there. Fannie and Freddie, luckily, they've helped out in this situation. They're going to work with borrowers as much as humanly possible to not report late payments, to possibly do forbearances, and basically tack it on to the end of the mortgage. So again, it's going to be the answer a lot, but it's a case-by-case situation, but there is flexibility and options out there.
So basically, I should tell my clients, hey, look at whoever you pay your mortgage to, check out their loss mitigation department. They'll
Correct.
give you what you need for your situation.
Yes, the best answer will come directly from the servicer.
Okay. Fannie and Freddie, they're providing some COVID-19 relief for like appraisals, employment verification. Tell us about that.
Sure. So they're aware, right, that there are things going on that are outside of everyone's control. So the biggest thing that I had a couple weeks ago was like, what's going to happen with appraisals? Because you have a couple different issues. One, what if appraisers get sick? What if sellers don't want to let people in? There's a couple different issues. So what Fannie and Freddie have said is for the appraisal side, you have to attempt to do an interior regular appraisal, okay? If you are unable to obtain that because A, the appraiser's sick, can't leave, B, the seller won't let them in, or for a variety of reasons, like you're just completely locked out, you can't leave your place, whatever, okay? The appraiser needs to note that in the system. If they're doing a purchase and it's a normal purchase, right, under the Fannie Freddie conforming limit of 765, 500, then what they can do is note the system, say, hey, I couldn't get access, I tried, whatever, and then we can offer an alternative, right? Whether it be a desktop view where they're just looking at comps, or the other would be they can do a drive-by and just take pictures. So depending on what they can do, there will be alternatives. But you can't off the bat say, all right, I'm not leaving. Like they have to make a valid attempt to do an appraisal and then go from there.
Okay, makes sense. So what's the turnaround time on this stuff for appraisals and underwriting right now?
Let me jump in on verification of employment too.
Oh, yeah.
So that's something that is causing problems for a variety of reasons. One is a lot of companies are working remotely. So these HR staff, no one's answering the phone. There's some issues documenting employment and that people are still active. Because on top of that, people are getting laid off. So you could be still working, right, but from home, and we can't get a hold of your HR department. So what Fannie and Freddie has said is you have to make an attempt to do a verbal re-verification of employment at least 10 days prior to closing. Okay, you have to try that. If you can't get that, then there's alternatives. You can show a pay stub dated within, I think it's like 2 weeks of closing, showing they just got paid. You can also show if they're like on a directory, a line. There's like a series of things you can produce as an alternative if you're unable to do this through May 17th. So they put that deadline in there for now that they're giving like basically 2 months of flexibility. Again, case by case, we're getting most of these done and it's fairly easy, but every now and then you're having an issue. So that's verification employment. So when you're asking about, what's going on in the process, things that are typically never a problem are becoming more complicated because everyone's working remotely, government agencies are not responding as quickly. Things like verifying social security numbers, tax transcripts, getting supplements done, right? All of these things are taking more time because everyone's working from home. People have Wi-Fi issues, right? It's like little simple things that you wouldn't think about when everyone's moving at full speed. Everyone's at 70% right now.
Right. So the timing is just taking longer because of all these little things piling up.
So to put in perspective, a month ago, if you said, Jake, how quickly can you close a loan? I would say if we did the full pre-approval 2 weeks, we wouldn't even think twice, right? I think that's gone for the time being. If anyone's thinking about doing a 2-week closing, I would talk them out of it. I would say we want to get closer to 30 days. Now, can things be done sooner than that? Sure, definitely possible. But there's a lot that can go wrong, right? It's not as guaranteed as it was a couple weeks ago. So what we're recommending for appraisals, at least 2 weeks. We'd like 3 weeks. For financing, same thing, at least a 2 to 3 week contingency, if not longer. And closing's about 30 days, if not longer.
Are appraisers considered essential business through all this?
As of right now, they are. So how it works is banks are, and again, I'm not the expert on this, so if someone is in the know in the government, like take what they say over me, but from my understanding and what we've discussed internally, so the financial sector is considered essential, okay? So then it's everyone under them, those contractors and third parties that support their business, right? So basically, essential business is extending credit and continuing lending money. So title companies are still considered essential and appraisers are still considered essential. As of now, things that are needed to keep the business of lending in business.
Okay, got it. Curveball question.
Sure.
Are you guys, your underwriters having any issues with any of these COVID-19 addendums that the associations are putting out?
Not yet. They haven't made their way through underwriting. They will this week.
Okay.
But for all of our understanding, there's no issues with it. I think if everyone takes the approach of we're in uncertain times, we have a seller that wants to sell and a buyer that wants to buy, we're going to work through whatever we can. If people are going in with the approach of gotcha, like you didn't deliver this contingency in the right amount of time, that's going to be a challenge for both parties, right? As long as people have eyes wide open and they're willing to negotiate and help and talk through everything, I think we'll be okay. But this whole idea of we want to waive financing contingencies and waive appraisals, in my opinion, it's too risky to do that right now with all these unknowns.
Right. All right. Let's talk about electronic notarization. That's a hot topic right now.
Sure. So as of today, we are not really able to do that. Okay. And there's a few different hurdles we have to go through. So one is there's legislation being proposed. Okay. So things are in the works federally where they're trying to make this a federal law where it allows for this. Some states are very against this, mainly California. Okay. That's one hurdle. So you have, I don't remember if it's the House or the Senate, but Congress is moving forward with legislation. Okay. That's one hurdle. Great. The next one is investors. So like, just because I say First Home can do this, right? Or First Savings or Caliber, someone can do it. That's wonderful, but they got to sell the loan to someone. Someone's going to buy it from them. Right now, the major investors, Wells, Truist, which is BB&T and SunTrust, AmeriHome, Chase, they allow for it. So basically, you would only have one option to sell the loan directly to Fannie or Freddie, which most lenders are not really interested in doing. So then there will be exceptions and extenuating circumstances and stuff, but that's the next step, is getting the investors on board. I would not expect anything in the short term, in the next couple of days, weeks, maybe in a month. No, it's my kind of guess. It's going to take longer than I'd like, but I would be pleasantly surprised if they moved it up.
What are some of the, that's great. Well, not great, but good explanation. I'm not going to hold my breath for this current time for that. So other like unexpected consequences that you're seeing in the lending world because of this?
I mean, we touched on it earlier, but like every little thing is taking longer, right? We talked about it at our last sales meeting. Underwriters are overwhelmed and appraisers were overwhelmed with the refis. Most of that's dying down now. Most lenders kind of increase their rates to curb more refis. So that's winding down. It's just everything takes a little bit longer now. So you got to be very detailed up front. You got to be very organized, and you can't. The other thing too is moving closing timelines. I know everyone's panicking right now and they want to move it up or change. As much as you can, stick to your timelines, because things are really trying to be worked on in an order, first in, first out, and also respecting that timeline, right?
Yeah. What about jumbo and like non-qualifying mortgage loans?
All right, so non-QM, for those who saw The Big Short, they're basically subprime mortgages. They were rebranded after 08, and they're called non-QM because they don't meet the federal government's guideline of what's called a qualified mortgage. They pretty much disappeared overnight. So these would be programs like bank statement loans, low credit score borrowers, no U.S. credit history. These are not Fannie Freddie normal loans. In really a span of like 48 hours last week, every investor pretty much disappeared. And if they were still around, they went from like 5 or 10% down to like 30% down and jacked up their credit requirements. This is all because we're having a liquidity crisis. So big picture, in order for that mortgage we create, someone down the road is buying it and someone's trying to bundle it and sell it as a pool, right? No one has any interest for those non-QM loans. Additionally, jumbo loans, so loans over 765, 500, which are very common in this market, right, with our average price point. We're going to see issues with that very quickly. There's no secondary market for jumbos. So if I do a jumbo loan with Wells or Chase or BB&T, we're selling it to Wells, Chase, or BB&T, and they're holding it. They're servicing it. They can't portfolio it. They can't collateralize it or sell it in the secondary market, right? Investors would rather keep the cash and be able to lend it out, do other things, but they don't want to be having it tied up in a mortgage rate of 3% or something like that. So we've heard from a lot of our jumbo investors that they're going to be tightening restrictions in the coming days. So things that like 10% down, maybe they're going to require 20% down. On the home equity line of credit, the credit unions may do some similar stuff. None of it is guaranteed today, but if we look at 08 as a, kind of a lesson in history, it's what we would expect, is the jumbo loans and the credit unions to tighten things up.
So it's actually a situation where some of our jumbo loan purchasers that are pausing might actually not want to wait to go into those uncertain waters if they're putting down.
Yeah, I mean, if you get lock commitments in and we can move forward, now might be a good time to do it before things change too much.
Right.
So yeah.
Okay. Foreign national loans, are those still possible?
Yes, assuming those were like Fannie Freddie and the normal channels. Things like where there's no U.S. credit history, diplomatic community, stuff like that, those aren't going to be available. But if you've been here a year or two, you have a credit score, you meet Fannie and Freddie's guidelines, those are still available. Those aren't going away.
Okay. We got this question here. Can you still offer lock-ins with float downs?
So that's a lender by lender decision as far as company decision. Our usual stance is we don't do float downs. Again, there are times when we can and we can't. That's why our typical stance is no. For example, jumbo loans, they honor float downs a lot easier than, say, a conforming loan. Usually our stance is if rates drop more than a point, then it's something we can consider. With all this volatility, we're telling our clients, at this point, don't expect it, but if we can do it, we'd like to.
Okay. One more user question right here. So when you're GWUL, EAH, HPAC,
so HPAP, EHAP, surprisingly, I got one in process right now, and they've been better to work with than usual, especially if you can get it through DCHFA. The Greater Washington Urban League is not as fast as DCHFA. So if possible to go through DCHFA, Zane is the processor over there. She's excellent. We've had no service issues with them at all. The Urban League traditionally, whether it's this crisis or not, is a little bit longer.
Okay, cool. We answered those questions. Guys, we went a little over the time I wanted to. I know it was rapid fire, so sorry for going so fast. I'm going to put the questions in order in the comments so that you guys could speed through it later if you're not watching this thing live. I guess I need to explain that to those people that didn't watch it all the way through this. But thank you so much, Jake. Super helpful. Obviously, I thought of Jake, Ingrid, Alex, our first home team to help answer all these questions you guys have been throwing at me because I'm not the expert and these guys are. So thanks for your time, Jake. We'll talk to you soon.
All right, guys. Take care. Be safe.
I think we're good. We went like